For years, we've heard the predictions about the wall between Wall Street and crypto finally coming down. Well, in 2026, it's not a prediction anymore. It's the reality. We are talking about the tokenization of real-world assets, or RWAs, and it's shaping up to be a multi-trillion-dollar market. So let's break down exactly how this revolution is unfolding right now. And hey, don't just take my word for it. Let's start with this quote from Larry Fink, the CEO of BlackRock, the world's largest asset manager. When the head of a firm that manages over $10 trillion says this is the future, the entire financial world sits up and listens. This isn't some fringe crypto idea anymore. This is the official blueprint.
So what does it actually mean to have Wall Street on-chain? For a minute, let's forget about all the speculative assets. We're talking about the fundamental plumbing of our financial system. Things like how long it takes for a simple stock trade to settle. With this new on-chain infrastructure, we're talking about that happening in seconds, not days. It's a massive upgrade.
And this really gets to the heart of it. For so long, the worlds of traditional finance, or TradFi, and decentralized finance, DeFi, were completely separate. They might as well have been on different planets. Now, those walls have completely crumbled. We're seeing a merger, a convergence of these two worlds into something brand new and way more efficient.
Okay, so how is this all possible? The key word you're going to hear over and over is tokenization. And honestly, it's a really simple but incredibly powerful idea. All it means is creating a digital token on a blockchain that represents your ownership of a real-world asset. So instead of a paper deed for a piece of property, you have a digital token. And that token can be bought, sold, and traded 24/7 anywhere in the world.
Probably the best way to really wrap your head around this is with a simple analogy. Think about Lego bricks. What if every single asset in the world could be broken down into these standardized, digital, programmable building blocks?
And this just illustrates the idea perfectly. A skyscraper is a massive, incredibly illiquid asset, right? You can't just slice off a window or the 35th floor and sell it on the open market. But what if you could? Tokenization lets you do just that. It lets you digitally break down that skyscraper into, say, 10,000 bricks, where each brick represents a tiny fraction of ownership. All of a sudden, this giant, illiquid asset becomes divisible, accessible, and super easy to transfer.
So what does this Lego brick approach actually get us? Well, a whole lot. First, as we just said, it unlocks liquidity. It makes things that were hard to sell easy to sell. It enables fractional ownership, meaning you don't have to be a billionaire to own a piece of prime real estate anymore. It creates markets that are open 24/7 with almost instant settlement. And on top of all that, it cuts out a ton of intermediaries and makes everything way more transparent because every transaction is right there on a public ledger.
Okay, so this all sounds great in theory, but here's the crucial part. How does this move from being a cool concept to a real, regulated financial product that the biggest institutions in the world are comfortable with? How do you actually connect a real U.S. Treasury bond sitting in a vault to a digital token on the internet?
To understand that, we have to look at the most important example we've seen so far. BlackRock's tokenized fund, which is called BUIDL. It launched back in March of 2024, and it very quickly became the go-to blueprint for how you bring institutional-grade, real-world assets on-chain the right way.
The success of the BUIDL fund really comes down to this institutional iron triangle. It's a three-part structure. First, you've got BlackRock, the asset manager, running the investment strategy. Second, you have a legacy giant like BNY Mellon acting as the custodian, physically holding the real U.S. Treasury bonds. And third, you have a company like Securitize, the tokenization platform, creating the digital BUIDL token. But here's the real breakthrough. That BUIDL token isn't just sitting in a digital wallet. It's actually being used as collateral and traded on DeFi protocols like Uniswap. Think about that. A BlackRock product is now a native building block in decentralized finance. That's a huge deal.
The success of Build isn't happening in a vacuum. It's actually part of a much bigger story that's unfolding. And that story is the great de-risking of the crypto market. The arrival of these institutional-grade, low-risk assets is causing a massive shift in how capital gets allocated on the blockchain.
I mean, just look at the before and after on this slide. Early DeFi was famous, or maybe infamous, for these mind-boggling yields. But they were incredibly risky, often generated by complex, unaudited, unregulated protocols. You could make a fortune or lose your shirt overnight. Now contrast that with the yield from tokenized U.S. Treasuries. It's stable, it's predictable, it's backed by the full faith and credit of the U.S. government, and it's being issued by the world's most regulated institutions. It's a completely different ballgame. So, why the big shift? It's actually pretty simple.
The market is growing up. Institutional investors and even the DeFi protocols themselves are all seeking safety now. They're making a flight to safety on the blockchain, moving away from the high-risk gambles and looking for a stable, compliant, and reliable place to park their capital. And tokenized treasuries, they're the perfect answer.
And make no mistake, this is not a niche trend. By the middle of 2025, the market for tokenized U.S. Treasuries just exploded to over $7.4 billion. And what's really fascinating is where all of this is happening. The vast majority of this activity, we're talking around 66% of it, is settling on Ethereum, really cementing its role as the foundational layer for this new financial world.
So, if this is just the beginning, what's the end game? What does this all mean for the future? Well, the potential scale of this transformation is absolutely staggering.
You know, back in 2022, a report from the Boston Consulting Group projected that asset tokenization would be a $16.1 trillion opportunity by 2030. At the time, that number probably seemed ambitious, maybe even a little crazy. Today, it's starting to look almost conservative. We are seriously on a path where tokenized assets could represent 10% of global GDP by the end of this decade.
U.S. Treasuries were just the perfect, simple first step. The real question is, what gets tokenized next? I mean, think about it. What if you could own a tiny fraction of the next big startup through tokenized private equity? Or invest in a portfolio of fine art? Or carbon credits? Or even patents and intellectual property? All on the blockchain? This is the future we're sprinting towards.
So, we're basically rebuilding our entire financial system with these new, digital, programmable Lego bricks. The huge question left to answer is, what are we going to build? Will we create a more open, more inclusive, more efficient financial system for everyone? Or are we just going to replicate the old system with shiny new technology? The future is still unwritten, but one thing is absolutely for sure. The RWA revolution is here to stay.